What's going on, Legacy Hack listeners and subscribers? Thanks so much for tuning in again for a great little jam session that we're going to have. It's going to be a little education, a little story time, boys and girls. It's going to be fun. I promise you, I got my dynamic duo, the two experts, the two guys that are just like smarter than even I could even dream of. Jack and Kyle in the room. And so we're going to dive into some things here, guys. So here's the first and foremost thing I want to kind of tee this up, and I want to pitch it over these guys is, so I had a potential client actually sit there and talk to me about, Tyler, I want to get the highest rate of return on my money inside the policy as I possibly can. And that's a big concern for, doing IBC. Okay, granted. And, for me, I felt like it was an issue that kind of derailed him actually doing IBC because he got so fixated on that one aspect of it. And I wanted to ask, Kyle, I'll pitch it over to you first. I wanted to ask you kind of, is your internal rate of return within a policy, should it be the most important thing that you consider?
I think it's a good question. I think it's the wrong question, to be candid. Like if I were to answer that question, I would first want to zoom out a little bit and go to 50,000 feet. Because if we're concerned about the internal rate of return inside of a policy, then we're zooming in on that one aspect of our financial strategy. And we really need to be thinking about like holistically, like what are the other opportunities that are available to us with that capital? Like for instance, I had a financial planner friend of mine, advisor yesterday, who threw out this thought that one of his clients has a ton of cash sitting in a savings account, and he's like, they're not even hardly earning any interest on that capital. They could at least put it in a high yield savings. And even that comment alone, I was like, but that's a very like zoomed in, like, sure, maybe they could throw it in that. But the question is, why is the cash sitting? Like, do they not have access to deal flow? Like, what's the purpose of this? Is this, emergency capital? Like why is this cash a part of your finances? And then how can we utilize it? And what are the opportunities available to us? And so the purpose behind infinite banking is really less about the internal rate of return on the cash that's sitting, more about like how much can we mitigate the risk that that's going to be too low. Like we want it to at least overshadow the cost of loans against it. But then once that cash is earning inside the policy, I think it's an important question to be looking for. How do we utilize this cash outside of our banking method? And where can we mobilize our capital so that we're, one, diversifying our opportunity so that we can get more returns on what we have, but also then we aren't getting hung up on one thing. Because I don't think the purpose of infinite banking is to necessarily go and create like a large storehouse of capital and then just set it in there and then forget about it. If you give money to the bank, they immediately go and loan, like, I think it's 10x against the dollar, which is shocking to me with like little to no reserves on hand. I know that during COVID, those restrictions got lifted a little bit. And so the bank is moving that cash. And in the same way, like we want to put on our banker cap when we put capital into our bank and think, what do I need to hold in there for reserves, like emergency cash on hand? Everything else, I want to find a job for those dollars so that I can mobilize them. So the earning potential for that cash inside of there is like one piece of the overall picture, if that makes sense. So asking the question, is that the most important thing? I would say it's important as a part of a greater picture. And then that kind of gets into the carrier question on the semantics of really the math of making sure that that cash is earning inside of there at a rate that makes the concept functional. But I hope that answers your question, because I feel like I'm kind of going in a couple different directions here. I'm not trying to go down each one of those rabbit holes, but just in general, I think it's important to zoom out.
No, I like that. I like the holistic approach versus just, focusing on the one aspect of this whole. It's almost like, you have a business and you only focus on, say you get a hamburger stand and the only thing you have on your, focus is how good are the napkins, or, how good is the hamburger quality patty. Well, there's a lot of other things that go along with your business. So I'm in total agreement with you with that. Jack, how about you, buddy?
Yeah, I agree with Kyle's train of thought. I think this is more about like where are we storing cash to grow it at a baseline, but also have max accessibility to it. Because you can do infinite banking with a HELOC, with a margin loan against a brokerage account. But with those, like a HELOC, you're going to have higher interest rates, less access to cash. Same with a margin loan. If the market drops, like they could call your loan and you'd have to pay that back. Whereas with life insurance, especially whole life, you you're going to have access to 95% approximately of the gross cash value at any time. Can use that for any reason, get it tax free, sent to your bank account, and pay 3.5 to 5.5% typically of a loan rate that is flexible. Like you can pay that interest only annually. You cannot pay it in a given year. So I think that's the why of using life insurance for this. And it's interesting because when we get to the infinite banking concept, we are talking about, oh yeah, access to cash and seeing that grow over time, hopefully quickly, in a way that it's like your premium goes in and you're growing by more than that by year 3 or 4. So that's definitely like an issue at hand. I feel like you can narrow it down pretty quickly though to who are the mutual carriers in this space. Let's look only at their whole life products. Let's look at the dividend history of the last 10, 20 years on those. But also like one of our primary carriers that we work with, like we got to chat with their chief investment officer and find out that they have enough cash on hand to pay out every single death benefit if every single policyholder died at the same time and still have cash left over. So it's like, oh, like that's a component of this too. And like you get to a point where, yeah, like you start by looking at the napkins of the hamburger stand, but then it's like, oh, I got creditor protection with this. Oh, like this will accumulate and like be something that I can pull from in retirement when other investments aren't doing as well. Oh, like there's long-term care with this. Oh, a death benefit is going to pass on. So it's like, yeah, you can start with like, oh, what's the best carrier in terms of rate of return? But really it's like that, I don't know, if you're using it well, and like Kyle said, have access to opportunities to grow your cash beyond an emergency reserve, like that component of it is small. Like, I don't know. Yeah, you'll have a difference carrier to carrier and where your cash value is at by age 65 or by year 5 of the policy. But like I don't know, it mostly evens out in the long run if you've been a good practitioner of the strategy overall.
Yeah, I again, the strategy, I think I have to go back to that right there is the infinite banking concept is a strategy for you to go and do other things with your money and not just kind of pigeonhole yourself to saying, okay, I'm just going to sit on this money. I'm going to warehouse it. I'm going to let it grow. And that's all I do. That's not what this whole concept is about at all. And by the way, guys, I just have to say this is that my napkin analogy of that little thing might have been pretty silly. So I apologize for that right there. But who cares? Who cares how soft the napkins are? All right, whatever. But one of the things, so I can still hear the guy talking to me about this, okay? And where I get where he's coming from, like, it is an important component. I mean, let's not diminish the importance of that, internal rate of return on the policy that, is accumulating. And I don't know, I believe I read this in Nelson Nash's books, one of his books, and it still kind of rings true with me, just if we're talking about the internal rate of return. I remember him saying something about it's not so much about the amount, like the percentage, like if it's a greater percentage. So like let's say it was 6.5% or it versus 5% or whatever, or 4%. It doesn't matter. the actual number is not that, it's the accumulation long term over time that what needs to be the big thing. Now, greater, if it's going to be a higher number, it's going to be a higher return. But you got to start somewhere. You got to actually start to accumulate over time to allow that to start to compound. So my thing is like you were saying, guys, is that yes, it is important, but again, not making it the most important thing, and making sure, going back to what Kyle said, what are you doing with your money outside of this? Because again, infinite banking is not a investment at all. It's not the investment. It's what you can do outside of that for investments. Does that make sense, guys?
Yeah, Tyler, there's something that's standing out to me as we're talking about this a little bit further, because even as I answered that question, I leaned immediately into strategy, but there's kind of, to validate the question, there's really two components involved, and Jack hit on it too, which is the question coming from a semantic standpoint of trying to make sure that you're vetting this policy properly? Because if that's the case, that's a totally different answer. Instead of going into the strategy of what you're doing with your money, like if you're trying to understand if this policy is a viable policy for you to bank out of, that's a great question to be asking. And it's not necessarily the most important thing is the return, but that the return against like the interest on the loan, because there's some carriers where their internal interest rates on loans is like 8.5%. And you're earning the same inside, like let's say 5 to 6% as you would be earning with a carrier who's offering a loan at 5%. And you're trying to really run the math here to make sure that you're actually working with the right person. So those are great questions, because I've had clients come to me with, I mean, sadly enough, I think this has happened to all of us, but I've had someone who moved away from me, went with somebody else who wrote a policy, and we talked later, and he's like, yeah, it's really hard to do anything with the money in these strategies because my interest rate's like 9% on the loan against the policy. And I was like, holy smokes, man. Yeah, you were, like I didn't know that he was going into that, but I couldn't speak to it sooner. But you're going into a, carrier that's really not suitable for this strategy at all. You're going to lose a lot of money in that carrier. So if it's a semantics question, just to validate, like your friend, I don't know if that's what he's asking or not, but there is a semantics side of this that's important, versus the overall strategy. Once you have vetted your carrier and you trust your agent and that like the numbers make sense, then for sure we're not as worried about this return inside this policy versus the return outside of it. And to validate what you just said there, Tyler, that number in there, it doesn't really matter too much how big or small it is, because you're doing two things at once with your cash. And there's not very many other options out there for us to be able to do this, where we're achieving two things at once. So I'll stop myself from going into the next thought because I know that took longer than I expected, but I just want to validate that question, because if it's coming from a strategy standpoint, zoom out. If it's coming from a semantics question, it's like lean in and tactically lean in and make sure that actually, we do know that this is going to work with the right carrier. And you're not just going to lose a lot of money on being in the wrong setup. So that, I think there's some validity to that question.
Yeah, that potential client that I had, it just became a big deal, and that's okay. I'm there, just like you guys would be, to kind of walk through that whole process and help them understand. Because again, one of the things that here, with the business that we had and how we've been trained, we want to educate the client as best we can. We want to help them through this process. This is not, a one and done, kind of thing. We're going to sell you on this and, have a great day and see you later. No, we want you to fully understand as best you can. You're not going to understand everything. It's impossible. Okay. But at some point you need to, pull the ripcord and do what you need to do, versus kind of just sit on your hands and, let your local bank make a ton of money off of you. So anyway, Jack, any other thoughts from you, my man?
It's funny that I go here in my head because this is not an investment. It's a savings vehicle. And I feel like it brings up somewhat the conversation of whole life versus IUL too. I think most people don't, in the whole life realm, don't know that IUL can have an early cash value rider and give you more access to cash right away. Even like we've had clients have more cash value at the end of year one than they paid into it premium wise in an IUL. So like so much of this conversation too, yeah, it is the proper product and carrier, but also the design. And I feel like that can be a separator for us, because we're practitioners. We've all put policies in place on ourselves where, yeah, we want to maximize access to cash right away, typically. So that's a component of it. And then, yeah, it's all like, I always ask, like, this is a good or bad return compared to what? And when you look at like a Dalbar report of the typical investor in the stock market, because we emotionally buy high and sell low, like the average investor is getting a 3 to 4% return in the stock market long term. It's why people get financial advisors to eliminate some of those emotional moves. But a policy like this kind of eliminates the guesswork in your own poor financial behavior by paying premiums on a monthly or annual basis and letting like the index that earns 0 to 9%, or the steadiness of a contractual 3% return plus a dividend in whole life do its work. And by the end, like the average annual return you need in the stock market to match what this gives you, accounting for like taxes and fees too, it's like you're not doing so bad with one of these policies, like compared to the average person. So yeah, design, and again, kind of like compared to what, like those are my two other thoughts when it comes to this.
Yeah. I mean, the design is critical, is so critical. Kyle, last thoughts, my man?
Yeah, I mean, it's hard to like narrow it down. I forget how much there is involved with infinite banking. At some point we should do an episode talking about more than one way to use your cash, just because I remember when someone's like, "Oh, you're using your money in two spots. You're buying insurance and you're borrowing against it." And then I actually wrote it out one time and I was like, "Actually, you're doing 7 things with your cash inside of your policy. You're accomplishing 7 different tasks, and then you can accomplish 2 or more outside of your policy, depending on how you use that capital." But that thought alone, though, just as we're wrapping this conversation up and what comes to strategy, is that this really, if you're asking, like, is this right for me? Whether you've been using it already or you're someone who's trying to get into it, I mean, the answer is really that it kind of comes down to your desire to have control over your money, and then the willingness to do the hard work to learn what needs to be learned to do this. I remember when I first got into practice, like the practitioner side, and then I started actually selling the product to friends and family. And people would ask me, "What does it take to get qualified?" And for me, it was a desire outside of your health, obviously, but it's just a desire to learn, like the willingness to kind of add complexity to your financial strategy and realize that that's necessary in the 21st century that we live in. And if that's not a core belief, that you don't want to add complexity, you want to keep things as simple as possible and have cash in your mattress, under your mattress, kind of thing. You know, it's one of those that may be a hang up. It may not necessarily be the right strategy. So I know there's that, you may both disagree with me on that. I don't necessarily believe it's for everybody. After doing this for about 5 years now, I'm kind of like, no, this is for folks that want that thing that's going to kind of force you to learn a little bit more. And obviously that's what we're here to do for you. But yeah, it's about the bigger strategy. It's about more than just the one piece that's, the interest earning inside of there, or the death benefit that's covering, the liability that you have in your life, or, whatever that is. So leaning into the strategy side of things, Jack, you said it, you're in good hands working with any one of the three of us on this call or anybody else from our agency, because we care more about the person we're sitting across from than the dollar sign at the end of the deal. And I think that's just extremely important when it comes to infinite banking, that this strategy is married to you and what you're trying to accomplish.
Amen, 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 amen. Well said. Yep. So guys, we're going to put a bow on this right here. This has been a great conversation. Again, to, Legacy Hack listeners or subscribers, wherever this finds you, our Calendly links, our schedulers are actually down here in the description. You can reach out to us, schedule a time to talk more in detail about this. That's what we're here for, is again to educate you, to make you aware of things and help you make an informed decision. And we love this. We're all doing this right here, all three of us. And so why not better? Because we know the bad sides of these things and the good sides. So we know what to kind of steer you clear of. And we want to do that. So without further ado, we're going to say, have a great one, and we'll see you later.